Have you ever wanted to help a friend or a relative get started investing? You know it's important, but you don't know quite what to say to them or how to convince them to start investing. This episode is for you to be able to share with them, share with your loved ones, so that they have an idea of where they should start and how to keep it simple so they actually do it. That's what we're going to talk about.
Sounds good.
Okay, go for it.
Well, first things first, we all know step one by now.
What's that?
You need to know your numbers.
Even simpler than that, we want them to better just basically, they just need to get started. What do? Do we already think that, like, yes, that would be the right thing for them to do, but let's try to focus on how do we actually, like, what people are realistically going to do. To not try to optimize, just
start.
Just get started.
Set up an auto transfer, like set up an automatic transfer into your, well, I guess they have to set up the investment account, right?
Yeah.
Step one.
So what are they setting up?
I don't know. Whatever they want. I can't suggest things, I don't think. Can I? Key trade? I don't know. Whatever. Sorry. Whatever, like, investment account they want to. See, this is too complicated.
Yeah.
Is this the point?
That's the point.
Like, just start. How do I start?
So the first thing I would say that you need to understand in order to kind of be convinced that you need to start as soon as possible. First thing, and it's really difficult to describe when you haven't experienced it, but that's compound interest. Mm-hmm. What's compound interest?
Compound interest is interest earning interest.
Yeah. And it might seem like a small thing to somebody that is, 19 years old, just left high school, and you're trying to convince them that investing for your future is really important. That might seem like a small thing, interest earning interest. But the fact is it makes such a huge difference. I'm actually working on another episode that we'll do at some point. But just as like a small preview, the difference of somebody saving between 20 years old and 30 years old versus saving from 50 to 60 years old is for almost 5 times the amount.
Wow.
Just because of time.
Yeah.
Right? Like when you choose those 10 years to save.
Yeah.
So compound interest cannot be understated. I often tell people when they come, they ask, okay, random question sometimes, but they ask, like, what should a goal be? And I'd say to most people that your goal should be to get to about $100,000 invested as soon as you possibly can.
That's actually a really good goal because it's something people can actually easily track. Mm-hmm. Because not that I hate them, I understand it. It's just like you said, like, just start investing. It's like, you start talking and you're like, oh wait, this is a little more complicated than I originally thought. Or things like, have 3 months of saving, have an emergency savings. Mm-hmm. It's like, well, what is, the number and stuff? So it's nice to have like a concrete, easy goal in mind. Okay, I was going to say really quick, do you think younger people view compound interest possibly as not that big of a deal because of their experience with compound interest? And I say that because...
Like what?
Like a savings account when you're young. It's like, open a savings account and you get like 20 cents. And they're big
if you've
deal.
only got $1 in there, 20 cents is 20%. So.
I understand. But do you think that's possibly why it's like, maybe it's a little harder to wrap your head around it, the concept of it? Like, yeah, I'm just saying possibly from that point of view.
It could be because I think for a lot of people, they don't understand it. I think actually to truly understand it, it takes a relatively high understanding of financial literacy. But I would say that the time hasn't happened. They haven't had the time. They haven't been on the earth long enough to experience compounding. So the idea that the $100,000 is the hardest $100,000 that you'd ever earn. Like once you get to $100,000, you're a quarter of the way at $1 million. Like it was something ridiculous, like saving time-wise. Because
don't quote you on that.
Yeah, for the other episode, I will get the actual numbers and I'll have it. But yeah,
significantly
because of the time it is so difficult to get that first, because the growth is negligible. So the growth doesn't really, like 10% of $1,000, who cares?
Yeah.
That's what I say about the $100,000 mark. That's when you start to see actual growth. Your investments are growing by $8,000, $10,000, $12,000 a year. That's more significant than... Why are you smiling?
I'm sorry. I'm just thinking of a connection, of course, and I'm like, this is stupid again. But I'm like, there's a song about this.
Oh, Jay-Z. yeah, absolutely.
I think he turned a 2 to a 4, 4 to an 8. Anyways.
Yeah.
But it's true. It's like when you start, just say that out loud. If you want to understand compound interest, double 2, 4. Double 4, 8. Oh, double 8, 16. Wow, this is starting to jump up a lot more. Mm-hmm. So it's like, yeah, it sounds small at the beginning, but as it goes, it starts getting so big. It like,
and it's funny because I work with people that they've said that to me. They're like, you get to a point, you save your whole life to hit certain numbers and you achieve certain numbers, and then the growth of your portfolio is more than you ever put in to the portfolio, like on a regular basis or anything like that. And you're just like, people have went and spent a bunch of money on cars and stuff like that, like 6 figures on vehicles and stuff, and they come back a year later and it's like, oh, there was a quarter of the interest that was earned in this portfolio, like over the past year.
Or like they earned it back within 6 months or whatever.
Yeah, like, so I'm saying it was a quarter of the interest. It was like, so 25% of what they earned on their portfolio just in the past year. It's nuts, right? It's very difficult to comprehend, but that starts small and you have to start. But time makes such a big difference that you wasting your 20, and I hate to say this because most people are older than that, and it's like, man, if you didn't start then, you have lost that time. There's no getting it back, which is the second thing that I think you really need to understand, is that time is so valuable that the idea that you'll learn and catch up later doesn't exist. Mm-hmm. That is not the way that markets work. You cannot catch up. Mm-hmm. Because you'll always be behind, because time plays such a big role. Yeah. So let's say you go and triple what you're putting into your investments. You might get back to the number, but the reality is if you had started earlier, you wouldn't need to do that. And if you still chose to do that, you'd be that much more ahead. Yeah. Because time makes such a big difference. Yeah.
Okay, so maybe I'm, again, jumping ahead, but a 17-year-old walks up to you and is like, what do I do? Just tell me what to do.
Okay, let's use 18 because at least then you can open a TFSA.
Okay, sure. I just picked a young person number. I don't know. Okay, so an 18-year-old walks up to you. What's the step-by-step process? Like,
we're on step 2 so far.
So step 1 is?
Just learn how compound interest works. Okay. And that's why, because you're trying to convince this person. This episode is mainly for
like convincing
parents to give to their kid and be like, hey, go and start this thing. Yeah. Okay. So I would want to convince you compound interest is important enough that you really want to take note, and that your money can out-earn your work. Like you going and trading your time for money if you do it properly. Yeah. And it can happen at any income level. In fact, the lower the income level, the harder it is to save, but the easier it is for your money to earn enough to replace your income, if that makes sense. If you're trying to replace a $50,000 income, that is a lot easier to do than replacing a $300,000 income. Right. Yes. There is always money that you can kind of put aside and start investing. It doesn't matter if it's $50 a month. Like if that's what you can afford, you should aim to get as high as possible, especially if it's just $50 a month. But that's where you start. You start with whatever. Doesn't matter. There's no too small number. Yeah. But it needs to be invested. Okay. That's why really important that compound interest. You understand how that works and why that makes a big difference. Yeah. So that was the. Okay,
understand compound interest. Step 2, you said.
Yeah, that you can't catch up later. So you trying to take the time to learn about it and make a really good decision. No. Not worth it. You start.
And then learn as you go.
And then learn come back later, right? And if you're going to start, then just use, well, we'll go through, but just use my defaults, right? Like just use the default, what somebody else is doing with very high financial literacy, just copy them and then learn reason why later. Because a lot of people will get into the paralysis analysis part.
Yeah.
And there is so much information out there that it can just be very overwhelming.
Yeah.
Plenty of people stop and they'll be like, oh, I'll come back to this in 6 months. I'll come back to this in a year. 3, 4, 5 years go by. And somebody like me will tell you that you missed out on $400,000 or $500,000 in your retirement because you decided to wait 5 years. Like that's, unfortunately, happens.
Yeah.
So back to your question, you're young. Where do you start? You start with the TFSA. So you don't know what to do. You go in, you open a TFSA. You have room likely, so you can go into your MyCRA account, but it's very easy to determine how much room that you have. If you're just starting and you know you have $5,000 to invest, you probably waited too long. So you want to be, as soon as you get a job, you want to be putting money aside.
As soon as you have income, I would say, because some kids do have, I mean, when you're able to open the TFSA and actually invest and you have an income together, start investing, because some kids do get other means of income. They get allowance, they get whatever, like they have.
Yeah. You should be doing it as soon as humanly possible. And TFSA, you have to be 18.
Yeah. And you have to be 18 to invest, correct? Or do you know off the top of your head?
I actually don't know off the top of my head.
I'm thinking about it. Yeah, is that a rule? To have any investment? I know some registered.
Well, registered investments, but I don't know.
Non-registered.
It's not really something I come across. 18.
Okay, that's what I thought, because I thought to open a... No, how old do you have to be to open a bank account? I don't know.
Bank accounts is way earlier. But so it's the age of majority. Editing Tré here. I don't know why I didn't think about this during the recording of the episode. Typically, for kids, we'd open another non-registered account under the parent's name, and we would just record it that money is for the child. We do this all the time with when the parent is putting aside money for other things that aren't education related for the kids. We just have a specific investment. That money is for said child, and as that child wants to invest their own money, we just add it to that pile. And that does mean that the parents pay the tax on it, but that's a small price to pay, I guess, to enhance the financial literacy of the child that much and give them a really good head start. Good, there you go.
That was number 3. Start with the TFSA?
Yeah, start with the TFSA, and then for investment allocation, pick 100% equity. And I know each individual case is different, and each individual case is different to a degree. But here's my view, I guess, on the investment allocation. And I've used this illustration before, but I use it a lot. So I liken investing to driving a car. The first time you get into a car, it is scary. If all you do is drive around your house and your block and your side streets, you will not realize the full freedom that driving gives you. But it is scary. But the more you do it, the easier it becomes. The first time you drive on a highway, it's scary. Suddenly, it's fine. You don't even think about it as a real risk anymore. The risks are still out there. The danger hasn't changed, but your attitude and your view of the danger has changed. You make precautions. You are wiser. You're maturer as you get older. So those type of
You've gained experience.
Yeah. If you never allow yourself to gain the experience, you will always be stuck driving around your block.
Yeah.
And when it comes to investing, it is very similar. The people that you will ever meet that have the highest financial literacy own stuff. They will buy equity. They will buy real estate. They will own stuff. That is how you build wealth in our type of society. You do not build wealth by lending other people money to build wealth with.
Yeah, because someone else is above you making money off of that, which means you're not making money.
That's the way it works. There is a risk reward when it comes to investing. but you can manage your type of risks. So start 100% equity, global index type fund, and then learn about it later, basically. And yeah, your $10,000 might drop to $5,000 and you might get scared, and maybe that is when you pull it out, and then you will learn. And hopefully the next time it happens, when it's $100,000, $1 million, $2 million, it isn't as scary because you've been through it before. And maybe you'll learn your lesson from when you panicked with $5,000, because the cost of the opportunity cost is greater if you avoid that than the actual risk that comes with investing.
Yeah.
Because the markets and global currency is so intertwined that if the markets go to zero or go half price, like 50% off, and stay there, the currency you're using is also worthless. So do not be one of those people that just sees risk one-dimensionally and just says, okay, well, I am low risk, so I need GACs for my entire life. No, that is a mistake. That is flat out a mistake. And it's not but for some people it helps you sleep at night. And I get that argument. That is why you need the experience. Because if the ups and the downs are stopping you from sleeping at night, it's because you haven't gained the experience prior to that. It's because you went from driving around your block to on the Autobahn in Germany doing 250 miles an hour. You do not do that.
Put it all in weed stocks.
That's a different type of risk. But you do not do those two things, right? You need to progress. You need to mature. And if you do not let yourself mature, and that will come with that balance going up and you seeing those ups and downs increase in value and go through that emotions and things like that come along with investing. If you do not allow yourself to go through that, you will not build the maturity to be able to handle it when it's serious dollar figures. And if the result of you not being able to handle it is that you avoid it, way more risk from a bad outcome point of view. So it's really important that you understand it. So that is my recommendation for people is don't at that point you have the capacity to take risk because you're so young.
Yeah,
you need to learn how to deal with that and invest your capacity, not your risk tolerance, because you don't have the experience to know what your risk tolerance even is.
Yeah. I was just going to say, it sounds like, first of all, the default episode that we talked about, like do the default and then ask yourself, why don't I belong in the default versus like trying to pick your custom plan. I forgot the other part. Gone again.
Cool.
Sorry. I can't remember.
And I will say, you mentioned like
Q
Trade is what I use for my personal stuff. Honestly, it doesn't really matter how you access this at this point. Unfortunately, it's very unlikely that you'd be able to come work with somebody like me because you're just starting out.
That's what I was going to say. It's nice because when you're young, it feels so detrimental. All of these things, like the driving illustration does not work because your life is never like worth more or less, right? But it, like, to have the dollar figures, it feels very detrimental when all you have is $5,000 invested and it drops to $2,500. That feels horrible because that's all you have. But you're right. It's good to gain that experience with those dollar figures versus later on when the dollar figures are so big. So it's like, it is important to start and have, it feels like a lot. Just like anything when you're young, it feels like the world is ending, but it's not. Like you gain experience and you learn that you can handle things and do hard things and whatever, like as you grow.
Yeah.
That's all I was going to say.
No, you're absolutely right. Yeah. Yeah. But what I was going to say was how you access the TFSA and things like that. Like you mentioned Q-Trade, Wealthsimple, walking into a bank. It doesn't really matter at this point because the dollar figures aren't big enough for it to matter. You know, like the fact is, again, if we talk about $10,000, let's say you are overpaying, right? Like you're paying 2.5%, which is to me criminal on investment accounts because you walked into a branch and that's what they put you in.
Yeah.
How much even is that? $250, you'll be okay.
Yeah.
While you get to $100,000,
yeah,
you'll be okay.
It feels like a big loss now, but through life you will probably lose money in one way or another. People get scammed. People, like, you make bad decisions. It will happen. It's gonna happen. Just accept it, learn from it, move on, keep going. Don't stop investing. Basically, and don't sell when the markets are down.
Yeah.
That's it.
Basically. Yeah. It's something that because for us, it made such a big difference, right? Starting at 20
yeah,
versus starting at 30. It made a huge difference to where we are today, to what we can do now. Yeah. And people just don't understand. You just don't, unless you, I mean, for me, it was first generation, right? Like, I had nobody to teach me. I just got really fortunate that it was something that I had to do.
And you were very interested in it. And you're a good learner. Like, you're a very quick learner, and you understand concepts easily and stuff. Because, yeah, even for me, like, when I started working at the bank, and I was 19 at the time, same thing. I would say first generation for me as well. Like, my family and, like, the mentality of money was more, I want to say, more positively inclined, in that it was like there was respect and value towards it.
It was a more conservative approach.
Definitely more conservative. Like, yeah. I would have, like you said, the cost of missed opportunity, that would have been me for sure. So yeah, like, I just remember even being young and, like, I was learning about it, and then you came along and were like, oh, this, like, you had an accounting background, and then you started going, like, you went into banking, you were taking all these courses and superseding me very quickly when I started. But
we had very different dreams.
Yes,
career-wise.
My dreams are, anyways, not in regards to finance, I guess, but
more puppies and shelter.
Yeah, I still want one day.
One day we'll see.
I'll open a shelter for the dogs.
Nope.
Great financial decisions. I'm like, we need more money for this dog who needs surgery. It was hit by a car.
Oh, gee.
Well, that's what the shelters do.
Yes, yeah.
I mean, you spend a lot of money when you have a shelter.
Absolutely.
That's why it's a not-for-profit. You're definitely not making profit.
No.
It's bettering the world.
One dog at a time.
Yeah.
It's true. Thank you. So anyway, yeah. And that is it. It is that simple.
Okay, so recap again. Let's hear it. Sorry, I love a recap.
Okay, finally, last recap is that compound interest really matters, and you should probably learn how it works.
Yep.
In the meantime, there is no catching up. Doesn't work like that. Don't think that you have the time and be able to fix it later. You do it now, and then you learn about it later. Number 3 is just start with the TFSA. Mm-hmm. There's a ton of different accounts, blah, 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 and some might be better for you. At this point, doesn't really matter. You need to start, and you need to get on that path of investing. Mm. Number 4 is just pick 100% global equity, low-cost index fund.
And then leave it alone.
Leave it alone, learn about it. And come back to it in 3 years' time when you've had time to learn a little bit more and you want to, whatever that is, but just start. And people think, well, what if the markets crash? I hope they do. Doesn't change it. It doesn't. If it was the day before 2008 happened, and you're now just starting your investing journey, and you put your $500 into that account, and it went to $250, and you stuck with it, and you kept putting your $100 in there a month. Good for you.
Yeah.
It doesn't matter. Those type of things are not. I'm trying to get you to be on the right path for your lifetime, for the next, I mean, if you're 20, the next potentially 80 years of your life, and teach you how to do that and get you on the right path for that, not teach you how to navigate the next market crash in the next 3 years of your life when you have $10,000.
Yeah.
It's irrelevant, but you putting yourself on that path, that's super, super relevant, and that will change the course of your life. That will change the course of your financial life.
Yeah.
So that is what I want you to focus on. If you're listening to this episode and you haven't started investing because somebody has sent you it, just start. Go walk into your financial institution, talk to them, tell them that you want to invest in the markets, open a TFSA, go with as close to 100% equity portfolio as they'll offer you. Keep it very diversified. Move on.
Yeah.
Okay. And then come back later and learn more.
Yeah.
Okay. That's it. That's what I want. That's what I want. So this episode, if you know somebody that you've been on the fence about talking to about this type of thing, but you love them enough that you want them to make really good decisions and put themselves on a path that will give them the best chance of financial success, send them this episode, and hopefully it will convince them to just walk into somewhere, open a TFSA, get invested, and come back to it later.
Yep.
See you guys in the next one.
Bye.
Thanks for listening. Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.